All right, here we go. Okay, it looks like from the S&P, we're still in this lower highs, lower lows, and we're at the top of that range as of today. So, when everyone else is getting excited, you have to look at that big picture. And the big picture right now is the Fed's been raising interest rates for a while, and it's going to take a while for that to get into the earnings reports of the stocks. So right now, what we have right now is we can't fight the Fed. We're just basically in a downward trend like this, something like that. Okay, and that's basically worked all year long, and we're right at the top of that right now. We're up for the we had a nice rally of something like 15%, 10% from the lows, but we have to have some really good reasons to break out of that downward trend. And right now we had great earnings from Apple today, and we had Amazon and Facebook had bad earnings this week. So we had a bunch of conflicting news stories. I'll go over those pretty soon here. Let's look at our calendar. We were expecting, we were pretty much oversold for a while, and we were expecting some good earnings to break us out of, where we were. So last week we were like right in the middle of this downward trend. So we had a little bit farther to go before we're at the top of the trend. So right now we have like a rally now, but it's kind of reaching, its limits. Okay, so what we have right now is an overbought market. You can see that we're at 90 right now in the Stochastics. Everyone's excited. We have the Treasury yield. It's going down. So we have a lot of things, in favor of stocks going up in the past week. 10-year is down 5%. 2-year is down 2.5%. So it's following our formula, and the stock market is up like 3% since last week. So we had a lot of volatility this week. We had Facebook go down 24% in a day. We had Amazon recently go down around 10%. It's down less now, but we had Microsoft, Google go down 7% the day they reported. So we have a consensus in, let me get this consensus of what's going on now. Hold on. Right, I'll go over that later. But one of the consensus is that companies are cutting back now, and they're not spending as much in ads. We have companies like Apple saying that their costs are going down because their competitors are ordering less items, making it cheaper for them, being the only remaining person buying. So, okay, let's look at the month ahead. So we look at this, we see we're overbought, we're in a downtrend. We need something major to break us out of this. We're looking at our catalysts for markets to go up and ones to go down. We see that we have a Fed meeting coming up next Wednesday. That's a catalyst. We have a CPI reading coming up on the 10th. So those are two possible catalysts, good and bad. But we're overbought now, so the chances are we're going to consolidate and go lower, in the next week or so, unless perhaps earnings or some other thing breaks us out of this downtrend. But if we look at the S&P right now, the important thing is we have a certain amount of momentum. It might be small, but if we look at some of the moving averages, such as a 10-day moving average, the 20-day, and the 30-day. A lot of, you can see this is the 10-day moving average. Okay, it's starting to go up. And you look at the 20-day indicators, moving average, 20-day, and that's a sign of momentum. And if we have, the 100-day, 200-day moving averages, majority of stocks going above those moving averages, then you have what's known as momentum, and then we can start plotting an uptrend instead of a downtrend. Lower highs, lower lows will have higher highs, higher lows. So let's see if we can break out of this. Let's see what else we have going on. Okay, we have Thanksgiving and we have Christmas to look forward to. And we have the Fed meeting on the 15th of December to look forward to. All right, those are the only catalysts we know of. And we have earnings pretty much finishing up in the next week. All right, let's look at some of our talking points. The 10-year and 2-year and 10-year, they went down this week, around 5%, 2 to 5%. So that's really good for stocks. We have tech earnings this week. Apple beat estimates, and that pretty much helped the market today. It was down initially, and then people are saying, well, this is a stock that we can rely on for its 7 to 8% growth and a dividend. So it's not easy to come up with something that's reliable to put your money in. There's a very good chance that people that were invested in some of the other big tech titans like Facebook, Amazon, that went down are going to reinvest into Apple. It's just more consistent, resilient growth. So Apple has a certain percent, I don't know exactly what it is, in recurring revenue. And companies, when they have recurring revenue, guaranteed money coming in, they sell for a premium. And that's why Apple can sell for 22 or 25 times earnings when the stock market itself sells for 15 or 16 times. Let me see. All right, so we had some earnings from Alphabet, Amazon, and Facebook. Each of them disappointed. And we were talking about Amazon, a couple weeks ago. We were looking at the PE of Amazon, and it was pretty high. We were doing calculations of what it was growing at versus, what it should be trading at if it's trading at its growth rate. And we said it would, if it reported anything other than what's expected, it'll take a hit. So Amazon was one of those ones that, and actually Apple is very similar. Apple's only growing at 7%. So if they had any kind of hiccup in their earnings where they didn't meet estimates, they would have been down 20% because they have that similar. They're only growing at 7%, but their PE is 28, 25. So Amazon didn't, they went down 10% today or so. And so we have some bad earnings announcements that took the market down earlier this week. But I think for the most part, earnings in general for the stock market are up or better than expected. We see the dollar is weakening. I added that to our catalyst for the market to go up. The DXY is down 2% this week. So as the dollar goes down, the profits of multinationals go up. So every one of the stocks that did bad this week, they reported that they had problems with foreign exchange. So it affected companies differently, but it's basically they're taking a 5% to 10% hit the earnings based on the dollar, which is appreciating. So that's going to resolve itself next year whenever the dollar is down. So whenever companies are sold off now and they missed it by maybe 6%, and that 6% was U.S. dollar strengthening, you might, for me as an investor, I kind of say that's noise. It's not necessarily less of a demand for their product. So let's see. But let's go over. Okay. Okay. So price of crude oil was up 6%, and there's a lot of reasons why oil goes up or down, but sure it's manipulated by some people, some organizations in the world. But for our purposes, the lower the price of oil mostly means that the economies in the world are not doing so good because there's less of a demand. But whenever the price of oil goes down, that lowers the input costs for a lot of the things that American companies make. The U.S. Treasury and the 10-year and the 2-year Treasuries are both down. So we're watching the 2-year Treasury because if it goes down, the Fed will not raise rates as much, most likely. And we already talked about the dollar being down 2%. So let's take a look at what ETFs are doing good. I'm sure with Apple's earnings, that got tech excited. So I'm expecting tech to be one of the best sectors today. Let's look. Change. Okay, so XLK, 4%. So, wow, that's a lot for a tech stock. I mean, for an ETF. So the biotechs are up, semiconductors. All right. So this is interesting. We have, we're overbought, and a combination, we're going up. I think Apple is what kicked off this rally. Biotech, consumer staples, financial select. Okay. We had something called, let's see. We had something called the Personal Consumption Index come out today. And along with that, there's a core PCE, and that rose 5.1%. So that came out today, and so it seems as though we're plateauing in our inflation using the numbers that came out. I'm not sure if that isn't basically good or bad. I mean, it's good that it's not raising more. But right now we have the ones doing the worst are the miners, the gold, oil, gold and oil. Let's look at what the price of oil is as of this morning. Okay, so the crude oil is down 1.7%. That's why the oil stocks are down. And let's look what's going up the most. I'm surprised oil's down, and then ExxonMobil and Chevron are up. That's weird. Okay, AbbVie had a earnings today, and they went down a little bit on their earnings. Okay, let's look at what else is going up and down. Energy. That's wrong. That's the wrong screen. Okay. All right, let's look at the price movers in the S&P 500. We have, I don't know anything about Dexcom. A lot of, oh yeah, they're a drug company. Wonder why they're up. Intel is up 9%. So that, I'm not sure why they might have, I'm not sure why, but all these semiconductors went up with Intel. All the semiconductors are extremely oversold right now. So this could be like short covering rally for all the semiconductors. T-Mobile continues its uptrend. It's one of the stocks we're watching as like one of the only stocks that were in this telecom sector that is taking share and growing at 30%ish. One's doing the worst, Amazon. They came out with earnings yesterday. Their estimates for the next quarter were not good. So even though they met their earnings this time, if they say they're not going to do as well and their estimates for coming quarter isn't good, then the stock tanks. So let's see what else. Edwards Life Science Corp. Not sure why they're going down, but this company does testing for drug companies. So if you had a drug that you needed tested to make sure it was safe, they actually do certain testing and give feedback for phase 1, phase 2 types of drug studies. And DaVita, they must be related maybe. What else? All right. So let's see what's in NASDAQ and what's doing good in the NASDAQ. Intel and Apple are pretty much leading today's rally in the stock market. They're one of the biggest companies. And Skyworks is going up because they make parts to go into. Basically, it's everything related to companies that sell to Apple. Like Skyworks makes some of the components in iPhones, and so everything that is related to Apple is going to go along with it. And let me see. I don't see any other themes. A lot of Chinese stocks are going down. I don't see Alibaba here, but JD and Baidu are two Chinese stocks. Perhaps because of geopolitical tensions. And in the Dow, we have every stock is up today. That's amazing, almost. Okay, so let's go back to our talking points. All right, so our talking points are, okay, this, okay, I mentioned that the dollar index is going down, so that directly affects multinationals for next quarter, not this quarter. All the money made as the dollar depreciates, it's going to be better for the multinationals. Let's look at the...
that list you showed of decliners, like Amazon's down 8% today.
Yeah, they reported earnings last night.
So I'm wondering why aren't they in the top decliners list?
Oh, they are. They are. Hold on for a second. Let me get that.
Sorry, maybe I was just missing.
Oh, you missed it. Yeah. So
that was you were okay. You were looking at Dow. Oh, okay. Sorry.
Yeah, I was looking at Dow.
I was like, there's a bunch of companies losing.
Yeah. So for the S&P, this is important. You got the Amazon.
Okay. So the Dow companies are all up. Okay.
Yes. Let's look at how to handle a drop. Say we got some of our watch lists, reporting this week, and how do you handle whenever Walmart drops down to here, right? We saw it drop 10 or 20% because of inventory problems. So this is what's happening to some of the tech stocks. This is like unprecedented. This is like one of the worst weeks for drops in big tech stocks ever. But if you look at how big stocks have dropped in the past, you basically have a day or two where they're consolidating, they go down a little bit more. But there's basically people that talk about, is this really a problem? Is this really? Walmart is an example of a stock that does good in recessions because people scale back and they downsize, their expectations and they buy cheaper places. So next time we have a drop, like today, we'll go over the drops that happen, with the big tech stocks today. But you'll probably see a pattern similar to this, where people are flushed out of a stock down to basically where a PEG ratio equals 1 or less. And after that, you're either in the position or you're not. If you're in the position, then you have to decide whether you get out or whether you keep the stock or add to it. If you're not in the stock, you have to say, well, has anything changed in the company's prospects where could I expect some kind of return over time? And if there's something that fundamentally has changed, then you have to decide whether you want to buy it or not. So what I've done is I think we're going to go through each of the stocks that drop 10 or 20, 25%, like Facebook did. and say, is this a long-term problem with the stock, or is just a problem with the charts and the actual stock price? Okay, so Walmart is an example. It dropped down to here. There was a little bit of rally. It went down. It tested the bottom. This is like a double bottom. And then you can see it has higher highs and higher lows. And now we're going to this higher highs, higher. We can draw a line up there, a line down here, and then it's kind of in an uptrend now. So let's look at some of the stocks that went down this week. Facebook. Okay, what we found out about Facebook this week is it went down like 24% in a day. What happened is they came out with earnings. They're basically spending an enormous amount in the metaverse. More than, they're only breaking even instead of having a lot of cash flow like they have in the past. In the past, they generated a lot of money and they basically had that cash available. But now they're spending it all on the metaverse, and it's called Reality Labs. So there are people that are saying, what, they can't continue to spend unchecked. There has to be some kind of board intervention where someone says, well, at what point in time do you have to rebrand yourself as Facebook and try to get those customers back that you had? So right now, what the problem is, I think Mark Zuckerberg is convinced that this metaverse is the next thing. And if they can be the center of the next internet and have total control over the next internet, they're going to exponentially be better than they are now. So they have this belief, but what people are saying about it is the current version of their metaverse is like, it's very unrealistic and no one would want to play in that, and it's not very good. So right now they keep sinking more and more money into this that could be putting more money, good money after bad. So it's and there are other people that say, well, Mark Zuckerberg, more than half of his wealth is in this company, so he wouldn't put more money into something that he didn't believe was going to be successful. So right now, this is like a crapshoot. If they put all their money into the metaverse, it ends up being nothing. Then it becomes less of a short thing. Like in Apple, you have recurring income for 30% of their total profit. So that's becoming more of a short thing. And so with this company, they sink an unlimited amount of money into this project, which may or may not be successful. That is what spooked the investors recently. So they're talking that it could be something like New Coke. Coca-Cola came out with something called New Coke, and it was better, sweeter than the prior version, and everyone hated it. So they had to do their backtracking, and it's classic Coca-Cola Classic, and forget about the New Coke. And so right now, Meta is super oversold, and right now it's trading below their PEG ratio, and everyone's trying to figure out, are they going to be profitable again? Are they going to continue to sink money into this, and is it going to end up being something that isn't worth anything and not people don't adopt it as a next platform? So that's the big problem here. So I think the end result, we compare this to Walmart, for instance. Walmart, we knew we had, they had customers that are not going away. It's a stable business that'll probably increase in a recession. And so that drop, we could say that their business model is intact. But Meta Platforms, there's a lot of questions here. Is the metaverse going to be successful? Are they going to continue to throw all their free money that they get after their expenses and advertise? Are they going to get their free cash flow and put it into this venture? So it's becoming like 30% chance of success for the metaverse versus maybe an 80% chance that Apple is going to roll like a snowball down a hill. So that's the problem. But if you want, that lottery ticket for the metaverse, this company is investing more than any other company. And if it does become something, this company most likely will be in the middle of it. So that's kind of what we have with this company. Let's look at Amazon. Any questions on Meta? Any comments? All right. So we'll go to the next one, Amazon. AMZN. What I did was I put together a little description. I don't know if you remember a couple months ago. So hold on. Okay. Amazon statistics. Okay, so we were looking at this only 2 weeks ago or so. We were saying that the PEG ratio was like 4. They're only growing, the earnings a certain amount, but their PE was at the time 60. So we said it was, about 4 times overvalued. And any hiccup in earnings, they will go down a lot. That's why you have to look at this PEG ratio just to get an idea of how much overvalued it is. And it's still overvalued now, but we have to wait for all the earnings estimates to finalize before we can really see that, how much it's still growing. So let's look at, we can see that these earnings estimates haven't changed since last time we looked at it. Sorry about this. Okay. But we'll watch this in the next couple weeks to see if this changes with the earnings, the estimates. Okay. So let's go back to some more of our talking points. Okay, so we had earnings announcements from Alphabet, Amazon, Facebook. Alphabet, they had, every one of these stocks had a problem with foreign exchange. Alphabet probably had one of the biggest hits to their earnings. And that's basically not their fault, but they had no control over it, let's say. But they're still growing between 10 and 13%. The ad market is slowing down because of the pending recession. And so that's hitting all the advertisers. Apple is an advertiser, and they didn't really mention a whole lot about that, advertising revenue being down. But the Amazon and Facebook both had that same issue with ad sales going down. So I'll go over a little bit later some of the things in common with all these major tech stocks, the problems in their earnings reports. Let me see. But we saw that the Apple could raise their prices in an inflationary environment. They basically kept their prices the same, but they sold more of their expensive unit. Their Apple 14 Plus, or the expanded model, sold out, and they couldn't keep enough of it in stock. So, but Apple is still one of the most profitable companies, and Google is too. So this, let's look at Google, because Google is another one that dropped 10%. And okay, so this is an example of a stock. It dropped. You can see that it dropped to like 92, 93-ish. And right now, the company didn't do that bad. It's still growing at like 10 or 13%. It just had a lot of headwinds, such as the slowdown in the U.S. economy because the Fed's raising the rates, and you had the foreign exchange. You had, but this is an example of a company that the business model is intact. Facebook is like in total disarray. I mean, we don't know what they're going to be selling 5-10 years from now, but Google is still going to be selling ads, and they still have 90% market share. So this is an example of whenever it drops 10%, the best thing to do is like Walmart. Whenever Walmart dropped 20% or 15% that one day, you have to wait for it to settle a little bit, and then buy a little bit at a time and hope it goes down again and another drop. Because let's look at, hold on. Okay, let's look at some of the top 10 contra fund holdings. Now, they still have Google as their top 10 holding. That's like 6%. And they've held it for a good 12 because Google did a split around 6 years ago, and they're still holding it. So it has to be, a stock that's still growing for these. I did a check for the majority of these big mutual funds. So you have to look at if you're at all interested in, a growth portion of your portfolio. When some of these tech stocks, they go down 20% or 10%. A lot of times you have like short covering. There's a lot of reasons for that to happen, but you have to put a small amount of time and keep in mind that you have to know if their business model is affected at all. Let's say the pandemic, all the travel stocks, their business model was hurt in a major way. They took on debt, and people might be afraid to go maybe on cruise lines. So that was an example of a maybe 2-year unknown for that company. But some of the stocks in each of these top 10 lists, they still have a business model that's consistent over time. So we have to be willing to leg into some of the stocks if they take a big hit. But right now, as I said, in the S&P, we're still in this downtrend. And we have to assume this until we break out of this downtrend, lower highs, lower lows, we're going to go down more and you're going to get a better bargain. But we never know whenever it'll switch. We don't know when it switches from a lower lows to an uptrend. And that's why you got to be invested at all time, because the best days are unpredictable. All right. Let me see. All right, let's go back up to the talking points. Where are we? Okay, dear greed indicator, we're getting to be greedy. And you can see, we've gone up, 10%? Let's just do that quick calculation. 357 divided by 357 divided by 387. Okay, 8% since 10/14 in 2 weeks. Okay, 2 weeks, it went up 8%. So people are starting to get greedy now. Just when we're at the top of that range, just when we're right here. Let's look at what else we're doing. We're getting greedy, and the VIX is going down. It's down to 27 now. So, we're at, that means that people are not faring as much as the past. And we could, if we break out of this downtrend and we start making some momentum, like we got a good earnings reports from Intel and Apple today. That was a pretty major catalyst for the stock market going up. But we need more of that. We need the Fed to say we're stopping raising interest rates. If that happens, then we'll start making higher highs and going in an uptrend like that. But we'll wait for that to happen. Let's see, what else? Okay, so we're at the top of this range here, of this downward channel, and most likely the next step is down, like this red line. We're overbought right now. People are greedy, and we're going into the best months of the year. The last 3 months, seasonality-wise, are the best months of the year. So why that is, I don't know. Maybe because people have a certain amount for their pensions that they have to invest before the end of the year. You have new funding that happens at the end of every year, and you have end of quarter, end of year, window dressing, a lot of things we don't understand. but we're still in the process of reducing the balance sheet. So even whenever there's a great day like today, we're still reducing by billions every day the amount of support for the economy by the Fed, and we're still raising interest rates. So usually when that happens, the multiples go down in the stocks. So that means stocks prices usually go down. So keep that in mind. Whenever this turns around and we're cutting rates and we're adding support to the economy, then we'll be well aware that the next things are going to be higher highs, higher lows. Right now we're in the greedy mode. I don't know. We were in this despair 2 weeks ago that no one wanted to buy anything. Now we're getting greedy. We're getting delusional. We're getting back up to that top of the channel. Just when all that happens, we get something that happens where we're going to go back down. We have a bad earnings report or whatever it is. We just have to be prepared mentally to hold stocks while we're going through this downtrend until we can start making higher highs, higher lows like that. Now, last 3 months of the year, October, November, December, are the best quarter of the year. And keep that in mind as we go through this quarter. Let's take a look at Google. Whenever Google went down like 9% or 7% the other day, it basically went down to the bottom of its trading range, like right here. And keep an eye on the top of this trading range, because we're still in a downtrend. We're still making lower highs, lower lows, but it basically went down to the bottom of this channel to a T. Down to a penny. And next stop is most likely up here. So let's look at some other stocks. Here's Apple. Apple's basically been in a trading range. It's only down 15%. I say only down 15% this year. But with its earnings report, it's probably up to here today. It's probably up to around here. So it's been one of the strongest of the big tech stocks because their earnings are resilient, and they're actually profiting from the recession because their cost of inputs are going down. So and let me see what else. Okay, so this is an example of another good stock stock that's doing well in this environment. It's Pepsi. They just reported earnings, and they're raising their prices, and they're raising their forecasts. So this is an example of an uptrend of the stocks we're watching. And they own Frito-Lay, which adds to better margins. It's like it costs them maybe 10 cents to make Frito-Lay chip bag, and they sell it for $4 or whatever it is, and they keep raising their prices. So that's an example of good margins. I wanted to say, I mentioned about how Walmart, if you see a big drop in a stock that we're following, you got to determine if it's, if their business model has changed. For Facebook, I think their business model is becoming more unknown. And so, whereas if you saw a quality company drop, 20% in a day, I guess the best thing to do is just to buy a little, and knowing that their business model is still the same, it just happened to be the dynamics of the stock made it go down. So let's look at what other stocks went down. Okay, let's look at T-Mobile. They went up 8% today. It's another example of a stock that's killing it. They're taking market share from AT&T and Verizon, and they're basically up at the top of their channel today. Up 4 or 8%. So we'll watch T-Mobile, and I think it's going to be an inverse correlation to AT&T and Verizon. They're actually becoming a better service too. So it's times like this where we have 20% drops in the big tech stocks, that we look at some of the top holdings of some of the biggest mutual funds, you can see that what we had for the past decade, at least for the last 10 years, we had an issue where all the tech stocks were going up and all the fund managers could not, they measured their performance based on the index, like the S&P. So if you had a mutual fund, you had to own top tech stocks or you'd be underperforming the index in your benchmark, and then you get fired. So there was a lot of pressure to keep pumping up and buying the big tech stocks so that you would at least perform as well as your benchmarks. But now you can see we were saying 6 months, a year ago. I remember Mark and I were talking about how Facebook, it's pretty risky to have, for a mutual fund to have a big position in a stock that's, becoming unreliable. And let's see if the contra fund changes, their positioning in Facebook in the next quarter release. They release their top 10 every quarter. So, but that was it was higher than this before. Now it's becoming less as the stock goes down. Let me see. So you can see Amazon, Berkshire Hathaway, Visa. They added Apple and Nvidia, and they reduced Netflix and Adobe. But the important part of this is I've been following this for at least 5 years, and you can see that their top 10 hasn't changed. So if a stock that's a quality stock goes down, you have to really say, is their business model changed or not? And I think the biggest problems for Amazon and Microsoft this week, they reported a slowdown in their cloud growth. So the biggest growth engines for Amazon and Microsoft were AWS and Azure for their cloud. And because they're growing less, they're growing like 20% now instead of 45% in past quarters. So that means that if they're slowing down, that businesses aren't spending as much for that now, then possibly they don't pay as much of a premium for their company anymore. So we see. All right, so this is an example of Fidelity Magellan. You can see that they've held basically these top 10 positions for over 10 years, I'm sure. And they kind of they bought some Nvidia and Netflix. They reduced their Procter & Gamble, MasterCard. But you have to see, do you have a spot? Do you have a need for growth in your portfolio? And whenever a stock that's in these top 10s that we've been going over is on sale, you have to say, well, I can start establishing a position in that. And so maybe you start at, 0.33% position when it drops a lot. And then if it drops more, then you buy a little bit more. And that's how you leg into a position. You see, Sequoia Fund, an example of, they have some of these big tech stocks too. You see. Okay, so this is a little summary of the earnings for the big tech stocks this week. Every one of them had a problem with the dollar strength. So that was between a 4 and a 13% hit the earnings. And that's something the companies can't control. You can't hold that against them. So that just might reverse the next quarter, and you just have to consider it. You shouldn't consider it when you want to own the company because it's something that the companies can't really do anything about. Okay, so slowdown in China sales is another common theme. There was a COVID lockdown, so you had some problems with manufacturing in China and with consumption because people couldn't get out to the stores. So all the companies that like Nike or Apple that have stores in China they had issues, for sales in China growth. And reduced corporate spending. People are spending less on ads, and they're spending less on cloud infrastructure. And you had wage increases affecting earnings. And a lot of this it seems to be temporary, and you have to consider that when you consider whether a company is reporting good earnings or whether you want to invest in it or not. A lot of companies are cutting corners. We mentioned 3 weeks ago, we said Google was being chintzy on how they allow on their expenses. So they wouldn't expense some business trips. They're cutting back on the food they give in their office. So we knew at that time that there's got to be a problem if they're cutting back on things, for their employees. And so a lot of companies are trying to cut back on expenses. And some of the companies made their earnings this quarter because they cut back expenses. So that's going to cut into their future growth. Increased input costs. Apple turned that around, and because there were less customers buying the things they need, they actually got a discount. But for a lot of high demand items like batteries and lithium, there was bigger input costs, so they had to raise the prices for cars, for instance. Freeze or reduction of workforce. So companies had to lay off people because of a lack of demand and because they had to cut costs. A lot of companies like Facebook and Google were focusing on AI, investing in increased spending. So that's another thing that hurt the earnings for a lot of these companies. So that was a theme that I saw this week. Is there any comments on that? Great. All right. So here's the article on Facebook. It fell to multi-year lows. You can see that you see the first earnings decrease. This used to be in a straight line. Now between this year and next year, they're expected to lose money. So that is, we like to watch stocks that are going up in a straight line. But now we have to really consider whether this company's a broken stock or a broken company. And I'm thinking it's twirling towards a broken company because they're getting away from their core competence. They're getting away from their core competence competence, which is advertising. And I have so anyway, there's a there could be a problem with this company. We just have to look at how the estimates come out after this week. All right, so so here's some comments that people made on their earnings. We're incredibly frustrated to see expenses balloon with an almost total disregard for investor expectations. And so they have an unproven business model with the metaverse. And they're becoming a more unreliable due to investment in an unproven business model. That's the theme. That's why people were scared out of the stock. And so the company, I didn't really follow up on what they said in the conference call to explain all these expenses, but that is an unknown. And most of the companies we follow are predictable, reliable, and this is becoming unpredictable. So we'll follow up on this as companies analyze it. Amazon was down 12% last night. They recovered a little bit, but their cloud was decelerating. It used to grow at 45%, and then we used to say that the value of the company was, the value of AWS was what they were trading at. So they got the Amazon.com for free. But now, because it's decelerating, they're only growing at 27%. and Microsoft was down 7% because their Azure was the biggest growth engine. It's decelerating. Is that temporary due to the slowdown in the economy? Most likely, because good companies have a good business model and they'll pick up and grow again whenever the economy gets better. So you have to see whether a business model is totally affected by you have to see whether a company's business model is affected or not by whatever's happening right now. I think it's temporary. All right. So Apple actually reported a really good earnings last night. And so it's not being hurt as much, and there's strong consumer demand for their products. They have all the phone companies giving away and buying their iPhones as a way to get their customers into their businesses. So they're consistently growing around 8%. They have a dividend around 1%, and they have input costs that are decreasing. So you can see that they are indeed still growing in a straight line, probably 8% a year with the dividend. So that's why I was in a bunch of earnings reports this year from big tech that were not so good. This is like a dim light. They're saying at least they beat their earnings estimates. So let's see, we already talked about Amazon. And all the numbers for Apple and Amazon, all these numbers will change in the next week or two. So we'll follow up with each of those and see what the analysts think. And they're going to revise their estimates, I'm sure. Let's see. Okay, one thing I found out just today. Janet Yellen is saying, is warning of something like a financial crisis, maybe worse than that. We're worried the loss of adequate liquidity in the Treasury market. So the Treasury market works like a supply and demand. They have auctions, and corporations, other countries, they bid on these treasuries, and that determines the yield. If there is a lack of demand and the Fed isn't buying anymore, then there could be a rise in government interest rates for the treasuries. And if that happens, then the government has all this debt they took on, and they have to service that, and it could turn into a huge problem. So we're just flagging this as potential thing to watch out for. It could be like a 2008 financial crisis problem. We don't know what could happen if that happens. But I'm just raising the black swan as it comes out to me. Hope it doesn't happen. Maybe the U.S. might not have a reserve currency status, or I don't know what will happen, but hope that let's watch that, see if it ever happens. And that is what I had to talk for today. I'm 1 minute over my time limit. Sorry about that. Any questions? All right, no questions. All right, well, thanks for attending, everybody. Have a great weekend.
Thank you.
Thank you, Greg.
All right. Talk to you next
Thanks,
time.
man.
All right.
Bye.
Bye.